Welcome to TFE Talks, Navigating Wealth, Business, and Legacy, the podcast from Thomas Fisher and Edwards. Each episode, our attorneys bring you expert insight on estate planning, business strategy, and legacy building, breaking down complex topics into clear, actionable advice. Whether you're solidifying a strategy we've discussed or preparing for what's next, this podcast is your resource for thoughtful, practical planning. You ready? Let's dive in.
Hello and welcome to another edition of TFE Talks. I'm your host, Jordan Goewey, and I'm joined today once again by Matt Edwards, who's a shareholder here at Thomas Fisher and Edwards. Matt, thanks for taking the time to join me once again today.
Happy to join. Always a pleasure, Jordan.
Matt, in the past when I've met with you, we've largely focused on some estate planning topics and tax topics. Today, I want to kind of touch on the other side of our practice with a business advising topic. And this is something that comes up often in our conferences with clients. Clients are often members of an LLC, or maybe they are shareholders in a corporation, but often they do not have the proper agreements between themselves and the other owners of the entity. And so we're going to talk today about the importance of a buy-sell agreement. And so starting off with the high level, what is a buy-sell agreement and why is it important for a business owner to have?
Sure. So a buy-sell agreement is really an agreement that is between co-owners of a business, and often is the business is a party to that agreement, that spells out certain events and procedures if an owner wants to sell their interest, or certain events occur that may require or indicate that the other owners may want to buy out the other owners, so that there's a set of rules in place when things are good that spell out if things continue as they are, we can all stay together in business. But if things change, what's the set of rules that affect how someone can enter or leave our business together?
Yeah, and I think that's a good high-level summary. So you say if things change, what are those triggering events that will typically trigger a buy-sell and cause these rules to come into place?
Throughout the life cycle of a business and business owners, the normal triggering events would be the death of an owner or the disability of an owner, particularly if they are an active participant in the business. There can be events where an owner's interest is intended to be transferred by operation of law, such as to a creditor or to a divorcing spouse by a family court. So if there's any mandatory transfer that the other owners don't control, or the individual owner who is subject to that trigger event don't control, the agreement would spell out, this is what happens in that trigger. So death, disability, ceasing to work in the business, or a creditor issue such as a divorcing spouse would be triggers.
And all of those things can, of course, be negotiated between the business owners. Mm-hmm. On the just broad strokes, there are typically two main types of buy-sell agreements, as I understand it, as far as the rules that apply. You have cross-purchase agreements, and then you have redemption agreements. Can you talk a bit on the distinction between those two, and is there one that's better than the other in certain circumstances?
Sure. So their cross-purchase, if we think about just a two-owner situation, if you have owner A and owner B, and they together own a combined business, then a cross-purchase agreement would have owner A be able to buy out owner B, or if there are multiple owners, those multiple owners could buy out owner B if that owner B is subject to a trigger event. So the owners are buying out each other in a cross-purchase situation. In a redemption type, the business itself is buying out the owner who is selling out of the business, and it can be in whole or in part. Generally, the transactions go two different ways for two main reasons. One, the redemption type is simpler. It doesn't really matter how many parties there are. The redeeming entity, the company, may have more liquidity available to it than the other owners. and there can be more certainty with respect to the structure of how that's going to play out, and it doesn't take as much complexity potentially in drafting the agreement. With a cross purchase, each of the purchasers are other owners, and so there can be multiple owners. They can have different forms of business interest, either voting or non-voting shares, and they can have different proportions. So there's more complexity there. One of the advantages of using a cross-purchase agreement is that the owners who are buying out the departing owner can sometimes get better tax treatment in a cross-purchase sale if they were to later sell that business interest. So some tax advantages weighed against simplicity.
Yeah, and I could certainly see where, if you had 100 owners in a business, it might be easier to just have the business buy that interest. Whereas if it's just me and you, then it kind of makes sense. I would just buy you out or you would buy me out.
Right.
If that, no matter how you structure it, if I'm buying you out or you're buying me out and we're in a business together, the first question that's going to come to mind for me is, what am I paying you or what are you paying me, and how is that determined? So how are businesses typically valued? Is it something where you're setting a price in the agreement? Is it something formulaic? Do we have to go out and get an appraisal, or what do you typically see on the valuation for these?
The backstop is often an appraisal, where an outside third party is engaged and paid to tell, as a neutral, what the value of the business is. That's almost a last resort, but it's in nearly all of our agreements, is to have an appraiser come and tell us what the value is. Certainly if we have a real estate investment business, we'll use appraisals for the real properties that are part of that business. For an active business, we'll value the business as a going concern. Business owners often don't want to contemplate paying for an appraisal and know that appraisal has uncertainty with it. It's outside of the business owner's control. So very often we see where business owners decide annually to, between themselves, set the value and put that into their buy-sell agreement, or determine a formula that may apply. When I see those, I always am mindful of the situations where I've had clients who intended annually to get together and set a value, and then they don't for several years. But if the business grows, whoever is the departing owner may lose out if that value is not reset. So when I write agreements, and I know you do this as well, Jordan, we set that a time limit. So if we set a price this year, and if we don't set it soon enough, then we default back to that appraisal. We'll also use formulas because our business owners know their business a lot of times best for how that business should be valued. But we want to stress test that formula and stress test it on a regular basis to make sure that formula still works, that it takes into account the growth, the debt, the economics of the business, and the economy as a whole.
Yeah, I think all of those are good points. I think there's trade-offs to all of it. The appraisers can have valuations all across the board depending on what appraiser you choose and what kind of information you give them. A formula is great so long as it can be consistently applied. If it's not consistently applied, then it could lead to fighting later. And I've certainly seen those agreements that just plug in a number. To your point, if you don't update that number often, which, surprise, business owners don't love constantly going back into their agreements and renegotiating and updating things, then that can certainly lead to problems. But I do like the sort of backstop that you described as, well, if that hasn't been updated over a period of years, then we default to an appraisal or something. That can be a nice middle ground.
Right.
So once that purchase price is determined, the other question is, how does it get paid? Because, Matt, if you and I are in a business together and you die or you leave the business and I'm supposed to buy you out, I'm either going to have to dip into my own pockets or I'm going to have to dip into the business assets and potentially hinder the business in some way in order to buy your interest. Are there other ways in which we can plan for a buyout so that it's not something that is actually a hindrance to either me personally or to, our business that we have together?
Cash on the barrelhead. I leave, you have to buy me out with cash. And as you say, huge liquidity issues, particularly if it's an unexpected event, a death or a disability. If it's a retirement, we can often plan for that. But for things like death and disability, we can often insure against them. So we may buy insurance policies death benefit or disability benefit policies. And the other option for business owners buying each other out is to just pay over time. Whether that is using outside financing with a bank or other lending source, or just if it were you and me, Jordan, if I were to leave, our agreement could spell out that you would have, say, 5 years to pay me a certain amount down, potentially all of the life insurance proceeds. If it's the death, that my wife would receive those death benefit proceeds, and then the remainder is paid over time. We see that, and there's always a tension between you desiring to have more liquidity and less of an outlay periodically, and me to have more certainty and get my debt that you owe me paid off faster with that. We'll see a number of years, we'll see reasonable interest rates, and business owners often will use insurance to hedge against this with a cross purchase with a few owners. And there's insurance for each of the owners. As the number of owners increases, that number of necessary policies expands dramatically. And so that's another reason that we'll see people use, clients use, businesses use a redemption type agreement for simplicity in that aspect as well.
Sure. And it seems like, yet another part where you have more options if you start early with this planning rather than trying to address it when it's time to actually purchase. And then maybe you're only left with paying in cash if that's what the agreement says, or maybe getting that outside financing. And so while we're on that kind of timing piece, when is the right time to discuss this? If you and I are going to start a business together today, and right now our business has no real value, I could see a situation where we don't exactly want to sit down and pay an attorney to go through all this with us. But do we wait until the business is super valuable? Do we wait until right up to the point that I'm about to, have to kick you out of the business and buy you out, or you're older and going to pass away? When's the right time to address these matters?
It really is, in a sense, a business prenuptial agreement. And so the right time to do it is right at the start of the business. There are cost and cash flow concerns with new businesses. And so this is the sort of thing where we could put into place more of a simple agreement initially and then have it evolve over time. But we really do think this is a foundational agreement for our business owners when they go into business with someone else. In fact, we talk about buy-sell agreements, but these buy-sell type provisions are built into every limited liability company operating agreement that we prepare that is for multiple owners. And a lot of times that will be just the basic, if one of us dies or becomes disabled, we'll go get an appraisal for it. So that there is some baseline in place for co-owners if the untoward happens early in the business during a high growth phase, that we know that there's at least some mechanism to getting the parties separated. Because if I were to pass away, you would be potentially negotiating with my spouse on what the buyout would be. And we choose to be in business with each other, and our spouses don't necessarily choose to be in business with each other. We really just want basic rules for the road, and it can evolve and change going forward.
Yeah, no, I think all of that is great advice. And so, as always, we want to give some sort of practical advice as part of this podcast so that a listener can actually take something from this. And so, what would you say, Matt, are the biggest mistakes that you see business owners make with respect to buy-sell agreements? And what is one step that a business owner can take today to avoid these sorts of mistakes?
I think I'll come up with two. One is, if you don't have a buy-sell agreement, and you have co-owners, you almost certainly need to have one in place. If everyone agrees on everything in the future during an exit, then you don't need one. That is exceedingly unlikely, both in the reality of the world and in my own personal experience. It is very important to have a buy-sell agreement in place. And then the second point is, if you have not examined your buy-sell agreement and you already have one in place, take it off the shelf, flip through it, make sure you understand it and that it still applies to your business and the owners in their current situation, each of the owners. in their situation, stress testing the formulas, the mechanisms. Probably it could use a tune-up, and that would be the next step. Really, is if you don't have one, talk to an attorney like me, like Jordan, like one of the other attorneys here, Thomas Fisher and Edwards, and let's make sure we understand that buy-sell and that it accomplishes the goals that we intend to have for all of the owners and for the business going forward.
No, those are very good points, and certainly that point about actually taking it off the shelf and looking at it. I think we sometimes meet with folks that they set up a buy sell when their agreement was worth a few $100,000, and it may have worked perfectly fine for that case, but since then they've added additional owners on, and the business is worth several $1,000,000. You probably need to, reconsider what those terms are and how it works, and maybe you need some more complexity at that point in time. And the other thing is, going back to something you said earlier in this podcast, a buy sell really is a foundational document for a business. But at the same time, it's not a document that you're required to have with the Secretary of State or under state law or something like that. And so just because you've on your own or with your other advisors set up an entity with the Secretary of State, and you have your LLC or you have your corporation, and you think you're good from a legal standpoint, that doesn't mean that you actually have all the foundational documents you need unless you think through something like this that is technically optional. You don't have to have it, but it truly is a foundational part of ownership of a business in my mind. So, Matt, thanks for coming on and talking with us about this very important topic. And I look forward to having you on future podcasts so that we can continue to provide this great advice to our listeners.
Great. Thanks, Jordan. Appreciate it.
Thanks for listening to TFE Talks. For more information, please visit our website at www.tfelawfirm.com. You can also follow us on LinkedIn, Facebook, and Instagram by clicking the links below in the show notes. If you have any questions about topics discussed in the episode, or you have recommendations for future topics, please email us at info@tfelawfirm.com. See you next time.